it's the last resort for you. Now I'm going to talk a little bit about federal foreclosure help. Two different programs that have been in the news a lot. Maybe you've heard. First one is called HAMP. HAMP stands for Home Affordable Modification Program. It was designed to help struggling homeowners avoid foreclosure by modifying loans to a level that is affordable. Now, there are potential challenges with the HAMP program. Your eligibility is based on meeting specific criteria. You have to be delinquent on your mortgage or face imminent risk of default. What does that mean? That means the people who are responsible, who've been paying their loan every month, but who realize that they have a problem that they need to address, they get turned down because they are not in default. You have to occupy the property as your primary residence. The biggest problem I see with the HAMP is that no principal reduction of your balance is possible. So if you turned upside down, you owe $300,000 on a house that's worth $150,000, I don't know what type of loan modification could really help. HAMP was supposed to help upwards of 4 million people to date. It has only reached about 300,000. Now, the second government program, maybe you've heard about it, is called HAFA. It stands for Home Affordable Foreclosure Alternative Program. This is an option for those who are not able to keep their homes through HAMP. They've tried HAMP, they've qualified for HAMP, but they still can't do it. It provides incentives in connection with a short sale or deed in lieu of foreclosure. Now, the program does pay you $3,000 to help you move, and it does guarantee that you do not get a deficiency judgment, but you have to be able to walk away from the home. You have to be able to leave. You have to have been in the HAMP program, not able to afford it, and then you can qualify for HAFA. Now, you may seek a loan modification. I'm sure a lot of you have a lot of questions about loan modifications. You've probably spent a lot of hours on the phone speaking to people who couldn't even get you a loan modification and kept you on the phone for hours and hours more, asking you to send in countless reams of paper, only to tell you that you needed to do it all over again. Well, loan modifications, when the lender reduces interest rates or changes the terms of the loan so that they're more favorable to the homeowner. There are challenges with loan modifications as well. The biggest one I see, lenders may be unresponsive to homeowners. Bank of America is being sued right now by 2 different states who are alleging that they basically led people around like dogs chasing their tails to get loan modifications that they were never going to give them in the first place. They're also charging fraud to Bank of America in relation to these same cases. The biggest thing I see, the myth of the modification. New terms may be unrealistic for people's current financial status. People hear modification, they think they're automatically going to get a deal that they can afford. A modification means maybe dropping something a percentage point, maybe saving you $50 a month, maybe $100 a month. Principal reduction of in loan modifications are very, very difficult. The banks are not very willing to give principal reductions of your balance. According to the U.S. government, the Office of the Comptroller of the Currency reported that more than half of all loan modifications created have already redefaulted 9 months after the original modification. 9 months after the modification, they are already in default again. Okay? We're going to talk to you a little bit tonight how to get yourself in a position to hopefully negotiate a loan modification, if that's your goal, from a position of strength with your lender. So you can get a little leverage on your lender so that perhaps you can get a deal that you can live with. I want everybody to be aware of foreclosure scams and schemes. Always, there are a lot of these people that come out of the woodwork when they're trying financial times. You need to be very careful. Foreclosure rescue companies have become widespread with promises to help homeowners avoid losing their homes. Unfortunately, many of these companies use questionable, sometimes illegal tactics. The result is often lost money, ruined credit, and a loss of any equity in the house, sometimes even losing the house itself. People have stories where they come to me and they said, somebody made me pay $2,000 up front to go seek a loan modification. I didn't hear anything for 6 months, and then I found out that the company that I gave the money to is no longer in business. What do? Well, you count a $2,000 loss is what you do. We're going to talk a little bit about predatory lending. I'm sure you've heard in the news some of the stories that have been swirling around. What is predatory lending? Well, it's when a lender or a mortgage broker engages in deception or fraud or manipulates the borrower through aggressive sales tactics or takes unfair advantage of a borrower's lack of understanding of loan terms. I'm sure everybody in this room read all 47 pages of their loan document and understood every line and every dollar amount and where it was going, right? All of the verbiage was perfectly clear to you, right? Predatory lending has been rampant over the last 7 to 8 years during the real estate boom. The Wall Street Journal reported in 2006 that 61% of all borrowers receiving subprime loans, what are subprime loans? Those are the risky loans. Those are the riskiest loans. Those are the ones that caused the crisis that we are in now. 61% of all borrowers receiving these risky loans had credit scores high enough to qualify for prime conventional loans, but they were put into the subprime loans. Why? Because it made the person that sold you the loan more money, and it made the bank more money. As far back as August of 2008, the American Association for Justice wrote, "Fighting foreclosures is the only way to make sure that consumers, especially those who were tricked into loans they couldn't afford, are treated fairly, because the banks aren't going to do it on their own." The next thing you should be aware of is questionable fees that the lender has added to loans. The New York Times reported an analysis of foreclosures found that questionable fees had been added to half of all of the loans examined. Half of all of the loans examined. Questionable fees on the loan, questionable fees associated with prosecuting the foreclosure case. If you don't have somebody looking out for you, you never know what they're going to put on the bill. Do you know if your loan has lender violations? 8 out of 10 home loans have lender violations. That's 8 out of 10. Some violations could give you leverage with your lender in negotiating a positive loan modification for you. They could possibly enable you to sue your lender for damages. There are extreme cases that could allow your loan to be rescinded, but those are only extreme cases. What you want to have somebody do is perform a forensic analysis, a fraud examination of your loan documents, and see what happened when you procured that loan. Even if you do not think that you were taken advantage of, 8 out of 10 loans that my office reviews finds violations. 8 out of 10. There are regulations that protect homeowners, and they protect people who are going in to get mortgages from banks and lenders. Among the laws designed to protect consumers in mortgage lending are the Truth in Lending Act, or TILA, the Home Ownership and Equity Protection Act, or HEPA, the Real Estate Settlement Procedures Act, or called RESPA, and of course the Fair Debt Collection Practices Act. I'll talk to you a little bit about mortgage securitization. What is mortgage securitization? Your loans were securitized. That means they were bundled up and they were sold like stock on Wall Street. They were sold to various investors over and over and over and over and over again. How does that affect your situation now? 30 years ago, if you got a mortgage from a bank, it was very likely that the bank would keep that loan. You'd go up to Mr. and Mrs. Smith's bank, and you knew where your loan was, and they knew who you were. You'd make the payment. They'd keep it for the life of that loan. That's no longer true. Most of your loans were sold on Wall Street, and that process is called securitization. In many cases, your loans were sold over and over again without your knowledge. The New York Times has reported that some loans were traded as many as 600 times while banks profited. The University of Iowa found that 40% of banks foreclosing on borrowers could not prove that they actually owned the loan. Why is that? Because some of these had been sold so many times that they have not kept up with the paperwork that is required when you assign a mortgage from one lender to the next. Lack of proof can prevent a foreclosure. If the lender cannot prove they have the original note, they cannot prove that they own your loan, and therefore they cannot prove that they have the right to foreclose. A federal judge in Cleveland, Ohio dismissed 14 foreclosure cases last year because the trustee was unable to prove ownership of the notes. Similar cases have been dismissed all over the country, including in this state. The lawsuit is part of a new approach to foreclosure defense. Because of lenders' bundling and reselling of mortgages, notes are often lost, misplaced, or corrupted. As a result, many lenders can't prove that they're owed payments and entitled to foreclose. How did that happen? Maybe you're familiar with the what's called MERS, or the Mortgage Electronic Recordation